Are you looking to improve your company's performance? Are you looking for ways to increase sales and profits? You need to understand and use the latest business terminology. Business jargon is constantly evolving, and to stay ahead of the curve, you need to be up to date on the latest business terms. By understanding the latest business jargon, you can analyze your systems and operations faster, communicate better with clients and employees, and stay ahead of the competition. So, in this video, we will learn about accounts payable, accounts receivable, accounting period, audit, balance sheet, and statement of cash flow.
Let's start with accounts payable. What is accounts payable? Accounts payable is the amounts of money owed by your company to external suppliers. This can include merchandise, services, rent, utilities, and more. Why is it important to improve accounts payable? There are a few key reasons why it's important to improve your accounts payable process. 1. To save money. If you're paying more than you need to for goods and services, then it's costing your business money. By improving your accounts payable process, you can negotiate better terms with suppliers and save your company money. 2. To improve cash flow. If you're not managing your accounts payable properly, it can lead to cash flow problems. This can make it difficult to meet your financial obligations, pay your employees, and grow your business. 3. To improve relationships with suppliers. If you're constantly late on payments, it can damage your relationships with suppliers. This can lead to them charging you more for goods and services, or even refusing to do business with you. How can you improve accounts payable? There are a few key ways you can improve your accounts payable process. 1. Automate as much as possible. One of the best ways to improve accounts payable is to automate as much of the process as possible. This can include using software to manage invoices and payments, setting up automatic payments, and more. 2. Stay organized. Another key to improving accounts payable is to stay organized. This means keeping track of invoices, payments, due dates, and more. 3. Negotiate better terms. If you're not happy with the terms you're currently getting from suppliers, then negotiate for better terms. This can include getting longer payment terms, discounts, and more. 4. Outsource accounts payable. If you don't have the time or resources to manage accounts payable properly, then consider outsourcing it to a third-party provider. This can save you time and money, and free up your resources to focus on other areas of your business. 5. Use technology. There are a number of software programs and tools available that can help you streamline your accounts payable process. By following these tips, you can improve your accounts payable process and save your company money.
Now let's move on to accounts receivable. What is accounts receivable? Accounts receivable is the money owed to your company by customers. This money is important to your business because it represents sales that have been made but not yet paid for. Accounts receivable can have a big impact on your business's bottom line, so it's important to keep track of it and manage it effectively. There are a number of things you can do to improve your accounts receivable and make sure that you are getting paid on time. Let's take a look at some of the key things you need to do. One of the first things you need to do is to make sure that you have a clear and concise invoicing process. This means that you need to make sure that your invoices are clear and easy to understand. You also need to make sure that you send them out in a timely manner. It is also important to have a good follow-up process in place. This means that you need to follow up with your customers after they have received their invoices. You need to make sure that you are chasing up payments and that you are doing everything you can to get the money that is owed to you. Another thing you can do to improve your accounts receivable is to offer discounts for early payment. This can be a great incentive for customers to pay their invoices on time. Finally, you need to make sure that you are regularly reviewing your accounts receivable. This means that you need to look at your invoices and payments on a regular basis and see where you can improve. By doing this, you can make sure that you are always on top of your game and that you are always getting paid on time. This can have a big impact on your business performance and sales.
The next term in the discussion is accounting period. What is an accounting period? An accounting period is the time for which profits are being calculated, normally months, quarters, or years. This is important for businesses because it provides a way to measure performance and compare it to other businesses or periods. There are a few things to consider when choosing an accounting period. The first is the business sales cycle. This will determine how often revenue is generated and when expenses are incurred. For example, a business that sells products online may have a shorter accounting period than a business that sells products in person. The second thing to consider is the business tax liability. Different businesses have different tax liabilities, so it's important to choose an accounting period that aligns with the business tax obligations. Finally, businesses should consider their customers' needs when choosing an accounting period. For example, a business that provides services to customers on a monthly basis may want to consider a monthly accounting period. Why is it important to choose the right accounting period? Businesses should choose the right accounting period because it can impact a number of things, including the business tax liability, revenue recognition, and customer satisfaction. By aligning the accounting period with the business sales cycle, businesses can ensure that they're only paying taxes on profits that are actually earned and that revenue is recognized when it's generated. Additionally, by considering their customers' needs, businesses can ensure that they're providing the level of service that their customers expect. Where do you want to focus your efforts? Your accounting period should be focused on the areas of your business that are most important to you. If you're trying to increase profits, you'll need to focus on revenue and expenses. If you're trying to improve your customer service, you'll need to focus on customer satisfaction. Why do you need an accounting period? There are a number of reasons why you might need an accounting period. Maybe you want better understanding of your business's finances. Maybe you want to track your growth and expand your business. Maybe you want to track your sales and launch a new product or service. Accounting period can help you measure and find ways to improve any or every aspect of your business. The bottom line is that your accounting period is a key time to assess your business's performance and find ways to increase your profits. There are a number of factors to consider when it comes to your accounting period. Keep these things in mind and you'll be on your way to a successful accounting period.
The next point of discussion is audit. An audit is an official inspection of a company's or individual's accounts. This is done to ensure that the financial statements accurately represent the financial position of the business. Audits can be conducted by internal or external auditors. Internal auditors are employees of the company being audited. External auditors are independent from the company and are hired by the shareholders or the board of directors. The purpose of an audit is to express an opinion on the fairness of the financial statements. The auditor will also look for any material misstatements. Audits are important because they provide assurance to shareholders and creditors that the financial statements are a fair representation of the financial position of the company. Audits also help to improve the accuracy of financial reporting and the overall quality of financial statements. There are 4 types of audits. 1. Financial statement audits. 2. Compliance audits. 3. Operational audits. 4. Information system audits. Financial statement audits are the most common type of audit. They are conducted to express an opinion on the fairness of the financial statements. Compliance audits are conducted to ensure that the company is complying with laws and regulations. Operational audits are conducted to assess the efficiency and effectiveness of the company's operations. Information system audits are conducted to assess the security and accuracy of the information systems. Audits are conducted on a yearly basis. However, companies can request for an audit to be conducted more frequently if there are material changes in the business. Audits are conducted in accordance with generally accepted auditing standards. These standards are set by the Auditing and Assurance Standards Board. The auditor will issue a report at the end of the audit. The report will either be unqualified, qualified, or adverse. An unqualified opinion means that the financial statements are free from material misstatement. A qualified opinion means that there are some material misstatements, but they are not significant enough to affect the overall opinion. An adverse opinion means that the financial statements are materially misstated and are not a fair representation of the financial position of the company. How can I improve my chances of a successful audit? There are several things you can do to improve your chances of a successful audit, including maintaining accurate and complete financial records, providing the auditor with access to all relevant information, cooperating with the auditor during the audit process, following the auditor's recommendations. An audit can be a valuable tool for your business. It can help identify potential risks and areas for improvement, and provide assurance that your financial statements are accurate. By taking the time to understand the audit process and preparing for it, you can help ensure a successful audit. Shareholders and other interested parties rely on audits to provide them with an independent and objective assessment of a company's financial statements. If you are a shareholder or other interested party in a public company, you should obtain and review the auditor's report on the company's financial statements. The auditor's report will state whether the financial statements are free from material misstatement. Similarly, you should obtain and review the auditor's report on the company's internal controls. If you are considering lending money to a public company, the auditor's report will state whether the company has adequate internal controls in place to prevent and detect fraud and mismanagement.
Now let's move on to balance sheet. Most business owners know that a balance sheet is important, but many don't understand exactly what it is or why it's so important. It's an essential tool for business owners and managers because it provides a clear picture of the company's financial health. Understanding of the balance sheet can help business owners make better decisions about where to invest their money and how to improve their businesses. It can also help sales and profits by providing a clear picture of the company's financial situation. A balance sheet is a snapshot of a company's assets, liabilities, and capital at a particular point in time. It's a key financial statement that provides insights into a company's financial health. The balance sheet can be used to assess a company's financial strength and performance. It can also be used to identify areas where a company may need to improve. There are a few key things to look for when reviewing a balance sheet. First, you'll want to check the asset side of the balance sheet. This includes things like cash, inventory, and property. You'll want to make sure that the company has enough assets to cover its liabilities. Next, you'll want to look at the liability side of the balance sheet. This includes things like loans and accounts payable. You'll want to make sure that the company has enough money to cover its liabilities. Finally, you'll want to look at the capital side of the balance sheet. This includes things like equity and debt. You'll want to make sure that the company has enough money to cover its capital needs. The balance sheet can be used to improve business performance by helping to assess where the company stands financially, identifying problem areas within the company, allowing owners and managers to make informed decisions about where to allocate resources, facilitating comparisons between the company and its competitors, providing information for financial forecasting and planning. If you're looking to improve your company's performance, the balance sheet is a good place to start. It can help you identify areas of weakness and formulate a plan to address them.
Now let's talk about statement of cash flow. If you're a business owner, then you're probably well aware of the importance of having a strong cash flow. After all, it's the lifeblood of any business. Without cash, you simply can't keep the lights on, let alone grow your business. That's why it's so important to understand your statement of cash flows. So, what exactly is the statement of cash flows? Let's take a closer look. The statement of cash flows is a financial statement that shows how changes in balance sheet accounts and income affect cash and cash equivalents. It also breaks the analysis down to operating, investing, and financing activities. In other words, the statement of cash flows is a great tool for understanding where your cash is coming from and where it's going. This, in turn, can help you make better decisions about how to improve your business and boost sales and profits. Why is the statement of cash flows important? There are a few key reasons why the statement of cash flows is so important. First, it can help you identify potential problems with your cash flow. Second, it can help you make better decisions about how to allocate your resources. And third, it can give you a better understanding of your business's overall financial health. How can you improve your statement of cash flows? There are a few key things you can do to improve your statement of cash flows. First, you can make sure you're properly tracking all of your income and expenses. Second, you can keep a close eye on your accounts receivable and accounts payable. And third, you can make sure you're using efficient methods for managing your cash. By taking these steps, you can help ensure that your statement of cash flows is as accurate and helpful as possible. And that, in turn, can help you make better decisions about how to improve your business and boost sales and profits. What are the 3 types of cash flow? Operating cash flow is the cash generated from day-to-day business activities. Investing cash flow is the cash used to buy or sell long-term assets. Financing cash flow is the cash generated from issuing or repaying debt and equity. Where can you find a statement of cash flows? The statement of cash flows is usually found in a company's annual report.